Hey, how's it going, everyone? Zachary Jensen, managing partner at TaxWise Financial Services here, where we're empowering small business owners to maximize tax savings and grow with confidence. Today, I want to share with you a tax strategy that has saved our clients over $100,000 in many cases, and tens of thousands of dollars in many others. It's leveraging a holding company structure for tax efficiency. This strategy only applies to business owners. So if you're not a business owner, don't worry. We've got a lot of other tax strategies that are great for you, but this one's not it. This is only for the business owners watching. So let's dive in. A holding company or holdco structure where a C corporation, or C corp for short, owns and works in tandem with an S corp or S corporation can provide numerous tax benefits for business owners. This approach offers opportunities for income deferral, retirement planning, and strategic payroll management, particularly when the C Corp elects a fiscal year that differs from the S Corp's calendar year. We're going to dive into the advantages of such a structure, focusing on key benefits, scenarios, and actionable strategies. First, let's understand the holdco structure and how it works. At its core, the holdco structure involves a parent company, a C Corp, owning an S Corp, or functioning as a consulting company receiving payments from the S Corp. This setup allows business owners to strategically allocate income and expenses, leveraging the differing tax treatments and fiscal policies of each entity. A quick primer on the differences between a C Corp and an S Corp. A C Corp is a separate taxable entity with a flexible fiscal year selection, offering lower corporate tax rates and the ability to retain earnings for future use. An S Corp is a pass-through entity where income and losses flow directly to its shareholders, and it avoids double taxation but requires adherence to specific IRS regulation. The S Corps are required to use a calendar year unless special permission is obtained from the IRS, which you actually have to fill out a special form for. While C Corps, however, can elect a fiscal year that does not align with the calendar year, allowing for strategic tax planning, and this is done more regularly. So the IRS does not require you to jump through the same hoops an S corporation would have to elect a fiscal year versus a calendar year. The first advantage of this strategy is targeted retirement contributions. One of the most significant benefits of this structure is the ability to manage retirement benefits strategically. By housing your retirement plan within the C Corp rather than the S Corp, you can avoid providing benefits to all employees. Retirement contributions in an S Corp must generally be provided equitably across all the employees. So by shifting this responsibility to your C Corp, the business owner can concentrate benefits solely on themselves or specific individuals within the C Corp. This is where we take advantage of the self-employed 401k benefits. A self-employed 401k within the C Corp allows higher contribution limits and increased flexibility compared to traditional plans. Let me give you an example. Consider a business owner with an S Corp employing 10 people. If the S Corp sets up a 401k plan, it must offer contributions to all eligible employees, significantly increasing costs. However, if the C Corp solely employs the business owner, only they benefit from the retirement plan contributions, reducing expenses while maximizing personal retirement savings. Another advantage is income deferral and timing flexibility. Another key benefit of the holdco structure is the ability to actually defer income. This is achieved through the C Corp's fiscal year flexibility, allowing the S Corp to pay the C Corp at strategic times to align tax payments and maximize cash flow. Let's dive into the deferral of income. The S Corp can make payments to the C Corp before the tax year end, effectively deferring the C Corp's income into the next fiscal year. This strategy allows the C Corp to manage its expenses, payrolls, and retirement contributions within its fiscal year, spreading the tax liability across different periods. An example of this would be, suppose an S Corp operates on a regular calendar year, so that's from January to December, while the C Corp has a November to November fiscal year. At the end of December, the S Corp pays $50,000 to the C Corp. Because the C Corp's fiscal year doesn't end until the following November, it has nearly 11 months to determine how to allocate that income for payroll, retirement contributions, and other expenses. Some benefits of timing flexibility: this deferral can provide cash flow advantages and allow the C Corp to strategically time deductions and investments to reduce taxable income. Now let's move on to the third advantage: payroll management and tax savings. The holdco structure enables streamlined payroll management that can result in substantial tax savings. Here's how we do it. The C Corp has a payroll for the business owner. By setting up the payroll through the C Corp, the business owner can control the timing and the amount of the salary, aligning it with the corporation's fiscal and financial needs. The C Corp can also deduct payroll expenses, further reducing its taxable income. You also avoid double payroll taxes. An S Corp may incur significant payroll taxes for employees, but by allocating some of the payroll to the C Corp, payroll taxes can be minimized. Example: let's just say a business owner receiving a $100,000 salary from the S Corp pays payroll taxes on the full amount. However, if the S Corp paid the C Corp $50,000 for consulting, the C Corp can then pay the owner a portion as salary, effectively spreading payroll taxes across both entities, reducing overall tax liability. Some additional considerations for this are legal and compliance factors. While the holdco structure provides significant tax savings, it is essential to adhere to IRS regulations to avoid penalties and audits. So we need to properly document everything and make sure that the purposes between the entities are different. So some potential challenges we could face are complexity in administration. We're going to have to manage 2 different companies, 2 different books, and 2 different payrolls. We're also going to need to follow the reasonable compensation rules for the IRS as far as paying salaries that are not too low, or else that could trigger IRS scrutiny. But don't worry, if you work with a tax preparer that knows their stuff, they can help you navigate this and come out ahead. So in short, a holdco structure involving a C Corp and an S Corp offers powerful tax planning opportunities. From targeted retirement contributions to income deferral and payroll flexibility, this setup provides business owners with tools to optimize their tax liabilities and financial strategies. By leveraging the fiscal year differences in strategic income allocation, you can achieve significant savings while maintaining compliance with the IRS regulations. Here at TaxWise, we do this exact thing for our clients, as I mentioned at the beginning of the video. So if you have any interest in that, feel free to reach out. Our contact information is in the description below. Really appreciate you watching this video and have a great day.